Hello, everybody. Good morning. It's Thursday. And there are sometimes I put these videos together where even assembling the content, it shocks and alarms me. It triggers me. But just remember, you're being lied to by financial media rags and TV stations, etc. There are a bunch of psyops that try to give you very misleading information. And I'm going to try to dispel some of that and also highlight the importance, the absolutely critical nature of being in the right assets at the right time, or else you are toast. That's it. That's the brutal, hard truth, everybody. And I will show data to back up this brutal wake-up call. Everybody's in the same market. Everybody's access to the same assets. But if you are not in the winners, you are going to drown. Okay? Again, if there's one video you watch from me, this is it, ladies and gentlemen. So let's get into the story. This one's called How to Drive Returns. And thank you to everybody for being here as well in the chat. And again, beware, this is a brutal wake-up call. I'll go fast. It's really about wealth creation in the US stock market over the last 100 years. A whole bunch of data dissected. And it also covers a little bit of crypto too. But crypto is kind of a new asset. It hasn't been around for 100 years. But we'll talk about that as well. And of course, this is not financial advice. And this is from Let's Go More Peace. Let's Go More Peace. I like that. An embarrassment of riches. You provide us some Patreon. Thank you so much for being part of the family. Today, I'll be talking about the core claim that I'm trying to portray here and the extreme skew in returns on different assets, okay? And the concentration of wealth by few. And is it difficult to pick stocks or not? And a whole bunch of data. So first of all, the core claim doesn't make sense to stock pick. Let's look at 100 years of data. A lot of people will say stock picking is impossible. BS. Anybody in Patreon knows what I pick, how I allocate, how I enter, how I exit. So if I can do it, anybody can do it if they're willing to do the work. But you have to not look at the media. Again, the stuff that comes out of mainstream media is absolutely horrifying, and it's getting worse by the day. It's driving you astray, but I'll show you the type of people you can listen to as well. Now, ready for some crazy stats? This is bonkers. Bonkers, all right? Absolutely bonkers, and it still stuns me. Over the last 100 years, from 30,000 stocks from 1926 to 2024, only 86 names out of 30,000 drove half of all the 80 trillion made. 40 trillion made by 86 names. Okay? Now you take the top 1,000 stocks, the top 3.5%, they generated all the wealth. If you are in the bottom 97% of stocks or assets, you are toast. You are toast. And you'll see a point here regarding matching the returns of 1 month treasury bills, which is basically drowning. I'll show you a stunning chart later in the presentation that'll blow your mind and terrify you. From the legend of our time in so-called stock picking on how his number one asset actually is not that good. So get ready. A visual of what I'm talking about here. 80 trillion made, okay? I'll blow up this visual so I can make sure I call out the right numbers. The top, I always talk about being in the top 1% of assets. Think the top 0.3% of assets or the top 3% of assets or the top 1% of assets. The skew is very important to be aware of. The top 0.3% of assets, the average return per stock is $186.05 billion, okay? 86 names on average generated $186 billion each. Okay, the top 3% of assets generated $79.4 billion each. The bottom 97% got you diddly squat. Nothing. Zero return. Okay? So if you think you're happy there with your little ETF or your mutual fund, you're stuffed, everybody. You are absolutely getting brutalized every single day. And don't not believe the data. Okay, we do data here. We don't do BS. Shocking. David Graham, thank you for coming. Now, move ourselves to the bottom right. 51.6% of stocks lose money over their lifetime between 1926 and 2024. Okay, I always talk about 60% of the S&P 500 being zombies because of the AI change. I lied. It's 97% are zombies. Okay, not 60%. It's 97% are zombies. I'm very animated today because this is so important. So you're going to see, again, I did warn you in advance. All right, they delivered a median return of minus 7.4%. And that's before taking into account debasement of money, which I'll get to at the end, which will stun you. All right. Over half of stocks lose, on average, 7.4%. Brutal. And the top 1% of stocks, my favorite, I always say, be in the 1%. That is 300 out of 30,000, generated annualized returns exceeding 20%. You've seen my videos on CAGR, compound annual growth rate, CAGR, CAGR, CAGR. If you can generate an average CAGR of 20% every year, you're going to make a fortune. Doesn't sound like a lot, but it is because of the miracle of compounding. NVIDIA, one of the best stocks ever, CAGR, 33.38%. You cannot make up that statistic, 33.33%. Amazon, up 49,000% since 1997. I'll show you more charts of crazy returns as well. Bonkers. And this is crazy. This is crazy. Stop. Sorry. Excuse the background noise there. Only 17 stocks, not the 86, but only 17 stocks delivered over 5 million % returns. Okay. Again, sometimes it takes an awful long time for that to happen. It could be 65 years. It could be 80 years. It could be 40 years. But still, that's a 50,000x. And extreme returns, very important. I'll show you as well. I always talk about getting rich slowly. Extreme returns don't require you to make it over 6 months or a year. Sometimes you do have to wait 30 years, 40 years. But holding on to those winners over time is game-changing, everybody. Yeah. Hey, Forrest, good to see you. Anyway, it's going to get even more wild, trust me. And Warren Buffett, the legend, everybody, the best in the world, okay? I do have my critiques of Warren Buffett. He was good back in the day, but he hasn't been good for a long time. But if the benchmark is beating the S&P 500, well, he did it, okay? His fund generated 43x over 58 years. Remember, I'm going to show you a stunning stat on this and towards the end as well in the conclusions. But only 12 of his 210 investments drove the gains. His hit rate is only 5%. If my hit rate was 5%, I would be poor. I want a hit rate of 80% plus. Okay? 80%. And even if he bets on index funds for most investors, it's just not good. Okay? That's legend. Warren Buffett. Shout out to Warren Buffett as well. And even worse, a lot of people, everybody has their money with these professional fund managers. Okay? These experts. All right? Okay, over the last 20 years, 94% of large cap fund managers underperform the S&P 500. If you are just matching the S&P 500, you are drowning, ladies and gentlemen. You need to be making over 14% per year. 88% of mid cap underperformed, and 86% of small cap managers underperformed. It's interesting. The big cap fund managers do worse than the small cap managers. I found that to be quite astounding. And this is also crazy. Everybody, all right? Half of all funds now are passive, which means they throw they throw stuff at the wall and let the index sort it out because nobody knows what to do. And that's gone up from 19%. Now it's half, 48%. Now it's up from 19% in 2010 because the experts at the top cannot beat the S&P 500. And now the retail investor sees that the people that are so-called experts are clueless. So therefore, they just throw it at the index, which means they're all drowning, everybody. We're talking trillions and trillions and trillions. Drowning. Okay? If anything is unclear here as I go through this, drop a question. Okay. It's very, very important. Hello, Holland, as well. And extreme skew in stock ownership as well. The top 10% of US households, by the way, although this is US data, it pretty much applies for everywhere. A lot of rich people in Holland, in the UK, in Australia, they own American stocks. Okay. That's where all the returns are, by the way, because that's where the disruption is and the technology is for the most part. And we're seeing a lot of challenges come out of China right now. But the top 10% of US households own 93% of all stocks. The top 1% hold 25 trillion. Top 1% own over half, 54% of all stocks. And the bottom 50% own just 1%. Another skew that will blow your mind, all right? Not only do you want to be in the top 1% of assets, but you should all strive to be in the top 1% of wealthy people here. You can do it, okay? Rags to riches, right here, all right? Now, a lot of people always look at the analog between venture capital and public markets. It's the same. VCs, they throw money at 20 different companies. All they need is for one to win, and then they're good. Then they make an outsized return on that one winner, even if the other 19 lose. So remember, you've got to pick the winners. You've got to be your own VC to win in this market. Okay? And the key to stock picking, ta-da! Well, I have a dedicated entire video on exactly that. But if you watch me on Patreon, you know exactly what I do. But identifying the rare outperformers in advance is very hard to do, but it's also very possible to do. Okay? So don't think you are a guru. Do a ton of research and also look at how industries are changing, how technology is changing everything, and position yourself for that future. It's very clear, if you watch my videos, what the future is and what's going to happen over the next 3 to 5 years. Okay? It's very clear. So be ready for that. Now, other thing that you have to understand too, sometimes holding, I know it sounds boring, sometimes it can really pay off as well. Not selling, not incurring taxes, but just holding on to a bag. And long-term investors benefit from that parallel distribution of returns. So imagine you bought something at $1 and all of a sudden it goes to $2,000. If it goes up $8 in a day, you're making 800% in your original investment. That's the power of the compounding as well. And patience. If you do build a stable of winners early, hold on to them, okay? I've never sold a Tesla share since 2017. Never. Not one. Because I know where this puck is going. Okay? Never. Crazy. And an example of holding. This is quite profound as well. This is Greg Schoen. He said, back in the 16th of May, 2011, this is called seller's remorse in an extreme case. I wish I had kept my 1,700 Bitcoin at 6 cents instead of selling them at 30 cents. Now they're at $80. Okay. just absorb that. The so-called experts who think they're being very shrewd and selling early. That's $190 million right there, ladies and gentlemen. $190 million. Anyway, the importance of holding. You know, it's okay to take some off the top, sell a little bit, hedge, whatever you want to do. My preferred option is hedging. But if you are in a winner, don't get greedy. Hold. Now, I'm going to talk about some examples of crazy stuff that's happened over 65-year periods, 5-year periods, etc. Okay. This is crazy. Late last year, I was 63% MicroStrategy in my portfolio because I went in, and you all witness it live in Patreon, a very hardcore, high conviction, concentrated bet on what I thought would be a brilliant performer. I've been in MicroStrategy since 2020, since September 2020, but I went in hard in the bear market when there was 75% down. Okay. And this stock, MicroStrategy, made up 63% of my portfolio late 2024. And the returns are up 3,200%. Okay, just one example of something crazy. But if you can identify, it's like, okay, Bitcoin's hard, Bitcoin's going to go up. What is the best proxy for Bitcoin? And how can I play it with leaps? Ta-da! Rest is easy. Tesla. A lot of people are frustrated with Tesla, but it's up 20,500% in 14 years. In fact, depending on when you buy, I'll show you another stat. If you buy dips and hold, you can do incredibly well. NVIDIA, up 4,500% in 5 years. Okay, crazy numbers. Actually, 5.5 years there. Costco, 40,000% in 35 years. This is one of those examples. I know a number of people that have Costco from a long time ago, and they had a little retirement account that was given to them by the company, and they still have it. And they look in their account and say, oh, I'm a multimillionaire. Whoops, how'd that happen? That's how it happens. Holding on to winners. Home Depot, 36,000% in 36 years. I thought that had a nice ring to it. Exactly 36,000% in 36 years. This is an example of generational wealth being created from having a tiny position, maybe stacking shelves at a Home Depot when it began, and holding on to those shares. Yeah, you went through a bit of a dark period between 1999 and 2009, 2010. It was down. But if you can hold, it works. Now, let's talk about the future, the all-in pod. I shared this, and a staff member said this was the most profound slide they ever saw. So I decided to share it again in case you missed it. The all-in pod discussed their choices for the future. I think it's Kevin on the top left. His number one choice is NVIDIA. Number two is Tesla. Kalakanas, Jason, Tesla number one, Google number two. Shamath, Tesla number one, Google number two. Shamath and, by the way, David Sachs has sat in meetings with Elon Musk. Shamath recently sat in meetings with the Optimus team and the Dojo team. His mind was blown. Well, he's an extremely smart guy. To blow his mind really must be something extraordinary. And you have David Friedberg, Google number one, Tesla number two, and of course Sachs, Tesla number one. And Sachs also does crypto. Well, I think he sold his positions because was working for the government, etc. But anyway, the point is, if you look at CNBS or any of these stations, they will not tell you this, but you look at these top capital allocators on the planet. Look what they do. Don't listen to me. Look what the pros do. Anyway, let's talk a little bit about buying dips. Okay. This is the retire on Tesla bag cost and the retire on Bitcoin bag cost. I threw them both in there. First of all, if you had bought, to get to your retire on bag, you need 1.2 Bitcoin by 2030, kind of my plan, or about 300 Tesla shares. And once you get to your first bag of 300, then you double it to 500, go to 600, and keep on building from there, okay? But the point is, if 5 years ago, your Bitcoin bag only cost you $10,800 to get to 1.2 Bitcoin, 3 years ago, it's $25,200. Today, it's 108 grand. 108 grand, okay? The key here is look at the cost jump between 5 years ago and 3 years ago. It's 233.33%. Again, crazy numbers. And between 3 years ago and today, 428%. Tesla, your retire on bag only cost 5 grand 5 years ago. Okay. 3 years ago is 32 grand. Today it's 99 grand. So when you position yourself and you allocate in layers and you buy dips, and the lower it goes, the more conviction you have because you know it's a winning asset, you can still make incredible returns. People say, oh, Tesla's been, not doing very well. It's because you're not buying the dips, okay? So remember, buy the dips, build a bag of that future asset, okay? That these people like, whatever it may be, you decide. Make sure you pick the winner, though. And let's get into the conclusion. I'm going to share a pretty startling chart here as well. First of all, Warren Buffett, I didn't mention him. He is the legend, okay? He only had a 5% hit rate. And his fastest horse was, guess what? Coca Cola. I do not drink Coca Cola. Never have, never would. But he did, he does. And so did his partner for a very long time. So anyway, maybe it's not the poison that I think it is. But the point is, this return is 125,000% over 65 years. Okay? Monstrous return. But what I'm about to show you next is stunning, everybody. Warren Buffett's fastest horse, Coca Cola, made a huge amount of return in 65 years. However, when you divide it by the growth in M2 over those 65 years, your return is only 2,000%. That's a real compound annual growth rate, real, taking into account debasement of 4.8%, which, again, top performing asset returns aren't that startling. Now, there's a lot you can learn from this chart. There's so much. I could talk about this chart for an hour, but I do want to point something out. If you look at the run up, I think it was up to, was it 97 or 98 on this particular chart here? Not only is one trick pony, yeah. But this is where I think it was 1997. What do you do in 1997 after that huge roll? You roll out, okay? You get out of the position, or you take a chunk off the table and you reallocate it. Because in real terms, since 1997, okay, nearly 30 years, this puppy has lost you money in real terms. And he's still holding, all right? He's still holding. You know, when you make, sometimes, you know, you can hold on to your one-trick pony forever, like the Home Depots, the Costcos, etc., because they're so well managed. But this, no. This is when you get out, okay? And the return sucks, okay? This is why you get into disruption. Again, so much to learn here. Other conclusion, remember this, over 100 years, okay? Concentration of wealth by a few firms, few companies, few assets, whatever you want to call them. 86 companies made half of all the wealth, okay? 1,092 companies made 100% of the wealth. That 192 includes the 86, by the way. Don't make sure there's no confusion there. 3% of firms from 30,000 companies made all the money. The 86 made the vast majority of the money. Very heavy, concentrated bets. And 97% were zero or negative. Okay? So take it away. 0.3% of the companies is what you need to be in, or 1%, or at least the top 3% if you can. Do not be in the 97%. Do not be in the 97%, everybody. And a shout out to Hendrik Bessembinder he's a professor at Arizona State. And I never knew, like you'd expect this type of research to be done by Wharton in my school, but no. But he said a brilliant quote from him, and he put together all of this analysis, all of this data of 30,000 companies over 100 years. Okay. And he said, I think I have provided some ammunition for the people who say it's their business to chase moonshots. Yes. The skewness shows just how big the payoffs can be if you're good at this. Yes. Pick stocks. I spend 40% of my time finding winners. Okay? 40, an inordinate amount of time looking around the corner, looking at what's next, studying the next big thing, next big revolution, being a so-called, maybe a futurist. It's so important. Don't forget to like and subscribe. This is an important one you need to share with your friends, okay? Those who are holding on to mutual funds, index funds, and thinking they can escape the metrics after they spend 20 minutes of their life watching this video, they will be awoken. Rudely, I might add, but they will be awoken. Shout out to Sean D, T&D Tesla. Jacob is here too. Hey, Jacob. Hope you enjoy the show. Let me know in the comments below if I was too brutal or you learned something. Please do. Feedback, and I can do more of these as well. These are things that you need to know to survive. The future is going to be absolutely brutal. Brutal. Been warning you since November 2022, but now I'm upping my warnings because it's getting even more extreme. Thank you all. Have a great day. See you tomorrow. Bye.